So I want to talk about option income strategies and how you can blend this with your current trading or something that you can start looking at for your future trading plans. Let me get going here. 1 second. So we're going to talk about a 5-step plan for option income success. Step 1 is avoiding that #1 option trading mistake. 2, the most important option factor for you to understand. And 3, how option pricing works. 4, we're going to go into knowing and using the market maker's secret. And 5, the highest probability option strategies for every market. So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. Again, thanks for the introduction, Reed. And yeah, I've been trading for over 30 years, and I was previously executive vice president for one of the largest oil trading companies in the world, Transworld, and went to Bermuda, spent over 15 years there, ran the international trading desk for over 10. And got involved with options during this part of my career and started trading options in the mid-'80s. So got introduced to options and kind of, been very passionate about the option trading ever since. Went on to launch the institutional over-the-counter option brokerage desk for PVM Oil London, and that's they're the largest privately owned oil brokerage company in the world. So another great experience, a learning experience. So, the great thing about trading that I enjoy a lot is that it's just a continuous experience as far as learning. So it's always, you never master it, but there's always so much to gain as far as the knowledge. So thanks for being here today. This was me circa '88 back in Bermuda at our trading desk, and that's kind of where I really learned a lot about trading. I started in 1980, but learned a lot here because we traded all the different markets and we're very big traders, so pretty much saw everything. So it's a great learning experience for me. Now, trading, for yourself can be one of the most rewarding jobs on the planet, but you have to, stay educated about what you're doing and stay focused on managing your trading. It can also be, a painful profession at times, as we probably all know here in the room, and when it's your own money at risk, and when I started trading my own account, it really changed the whole game for me because when it is your own money, the losses become so much more personal to you. So I had to quickly learn and to adjust to better control my risks. And a real kind of aha trading moment for me came when I started to incorporate income option strategies into what I was currently doing. And this really changed the way that I viewed trading and really helped to give me a more smoother equity curve, more consistent profits. So that's what we'll be talking about today. Now, the first step is to avoid the #1 option trading mistake. Option trading has so many more advantages than trading stocks, but as you probably know, it's a bit more complicated as well. A trader, options can be intimidating at times, and that's why many investors trade options by purchasing those out-of-the-money type options, such as short-term options, since you'll notice that they cost a lot less than a longer-term option, and it's really a simple strategy. So, for example, the out-of-the-money calls are especially popular because they're cheap and seem to follow the old Warren Buffett paradigm that we all have kind of grown up with, is to buy low, sell high. But is this really always the best option strategy that you can use? Well, imagine you're bullish on Facebook and it's trading at $65. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration that would have a strike price. The $80 calls would have a strike price of, say, would cost you 15 cents or $15 per option contract. So you look at this and you do the math, and it just looks, just so powerful and just so appealing because it's cheap, and you start doing the math and you can see that you potentially could make a whole lot of money. Now, if you were to purchase 100 shares of Facebook at $65, that would cost you $6,500. But for the same $6,500, you could, go out and buy over, 400 contracts, 433 contracts of those 80 calls, and be able to control over 43,000 shares. So you look at that, and you're like, your eyeballs are popping out. And Then you go a little bit further on your math and you think, well, what if Facebook would hit 81 within the next 30 days and those 80 calls that you bought at 15 cents are now at $1.05, which would be 105 per option contract. You look at that and you could see that you would make over $38,000 in a month. And that kind of profit in 1 month is pretty tempting, pretty amazing to look at. At first glance, this kind of leverage is awesome, but don't let that glitter fool you, because not losing money is just as important as making money. So one problem with short-term out-of-the-money calls is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. And that really ratchets up the degree of difficulty. So to make a profit, the stock doesn't just need to go past that strike price, but it also must do it within a defined period of time. Now, in the case of these 80 calls on Facebook, you would then need that stock to reach $80 within 30 days to make a profit. And it's this dual objective of having to be right on direction plus timing. This really lessens the probability of an option trade being a winning trade when buying options. And everything I teach my clients and members is based on, first managing your risk and increasing the probability of your winning trades. So in this Facebook option trade, you're wanting that stock to move more than 23% in less than a month. And this would be like a 2 standard deviation move, which in options we can measure. And how many stocks are likely to do that? Well, we'll see a few from time to time. You'll see the Teslas and the Netflix like that go crazy, but really not many. So in all probability, the stock would not reach that strike price and the options would expire completely worthless. So based on probability, and we can use standard deviation to help us with that, there's only about a 5% chance in this example of that stock reaching 80 by its expiration. So in order to make money on the out-of-the-money call, you either need to outwit the market or really get lucky. So being close means no cigar. Now imagine that Facebook rose to 75 during the 30 days of that option lifetime. Well, you could pat yourself on the back and say, well, you're right about direction that the stock moved, but since you're wrong about how far it would go within a specific time frame, you still lose your entire investment. And that's always, outright painful. So based on this trade example, in my opinion, a better goal for every trader is to select trades based on what provides the most consistent positive returns, not a one-time big winner. And consistency is derived from making high probability trades based on reliable data and facts. Where there's a big disadvantage, such as the one you just saw in this option buying scenario, you can usually just look at the flip side of the coin and see an equal opposite advantage. So in this case, being a seller of options gives you a huge advantage over being a buyer. And the pros know this, and they take advantage of it, and so can you. So as a seller, all the things that you saw in that example are the same, but they're in your favor instead of against you. So this is why a lot of people and a lot of professional money like to sell options for the income that they can receive off of the premium that they take in. Now, by selling options, you're in essence selling time, and I like to compare an option to a coupon that you might get at a grocery store that must be redeemed by an expiration date, or else it's no longer going to be valid. So how's this done and what's involved? Well, step 2 is the most important option factor for this kind of income generation. It's understanding the concept of time. And it's pretty simple, you could see from that one example. And time value is used for trading strategies that take advantage of the accelerated time decay of the option into its expiration. And the option income strategies, they're very, very tied to the time value and the impact that it has on that price of the option. So what exactly is time value? Well, it's the extrinsic value of the option. That's what it's called, and it's the premium exercise value, the intrinsic value, and this is based on its potential to increase in value before expiring. And this probability will always be greater than 0, thus an option is always going to be worth more than its current exercise value. Now, we're going to take a look at a chart here, and you'll see how predictable and powerful this option time paradigm is, and then I want to answer you. I want you to answer a simple question. So here's a kind of a chart to show you time, and when you start 120 to 90 days out, you have very, very slow time decay, or in options we call this theta decay, And as you get closer to the expiration, 30 days out, weekly options, that really speeds up. And before you know it, you're at zero. That option is worthless. So when you're buying options, unless you get a really good movement to the upside in favor of your option, if you're long calls, this time decay is going to really take away this momentum, and you really need that extra push to make up for that time decay that's going your face, like swimming against a major tide or major current. So if the underlying security, just think about this, if the underlying security was to go sideways and have no direction, would you have wanted to have bought those options 120 to 90 days out, or would you have rather sold those options? So, if it goes nowhere, the better thing would be, yes, sold. Now, this is a common natural time value progression, and it's for all options. And it's kind of like falling off a cliff blindfolded, because you are kind of lost if that thing is not going up in your direction. Now, step 3 then is, well, then how does the option pricing actually work? Well, basically the main components of an option price will be your time value times the implied volatility times that intrinsic extrinsic value. And once you know these key variables, then you can, are ready to price that option and know what its premium should be. So here's another chart to kind of illustrate this, how the pricing works. So you have your time value. Now this is a weekly option series, so every Thursday you have a new series come out. And then you have time value times the implied volatility times the intrinsic extrinsic, and that gives you the premium or the cost of that option. So I kept the intrinsic extrinsic value here constant and just change, you'll see how the change in time value affects that price. So here the first step, time value still in that option times 300, you put in the implied volatility, so that gives you a price of $300. Now you can see here when you come in on a Monday, you've cut that time values in half. It's half the value that it was when it started. And even when you increase that implied volatility, you barely increase the price of that option, and before you know it, you're down here at zero. So that's how time value can really affect things, and by knowing it and taking advantage of it, you can have some really great benefits. Now, step 4 then is the market maker's secret. And it's what they really don't want you to know, because a lot of times this is how they're going to make their money. So you think about broad markets, they'll tend to have 2 to 3 week cycles and will trade in sideways channels then for 70–80% of the time. You'll see them spike up or have some really good trends up or down, and then all of a sudden they'll go sideways and feel like they're doing nothing. And it's based on the sideways price movement that these out-of-the-money option buyers then are going to lose approximately 70% of the time. So market makers that make the option pricing, they know these statistics, and therefore they tend to trade from the sell side, selling that premium, collecting it. And this is what you can call as the professional money. So it's good for you to understand what they're doing and then try to take advantage of it yourself if you want. And it's all based on the math. Now, market makers use mathematical market probability statistics for pricing the movement of that option to its expiration. And we all have now option pricing models on most of our platforms, so we can use this information too. And knowing the probability of an underlying security finishing within a certain range at expiration is key when you're determining what option you want to buy or sell and what option strategies to implement. And it's these statistics, this forecast, they will forecast how likely it is that that option will fall within a certain price, either up or down, by its expiration. And it's this statistical forecast which is referred to as the implied move of the stock. Now, it's the implied move. This is also an estimate or theoretical estimate of a plus or minus 1 standard deviation move of that underlying security by its expiration. So when you know these inputs, then you can get a pretty good feel. You can put together targets for where a stock or the underlying might go. So here's an example to illustrate this. This is a statistics. You probably recognize this as a normal distribution curve for looking at probabilities. So the way probability statistic works is that for this particular type of income strategy, you're shorting a vertical spread, or credit spread is what it's called. Now, when used correctly, this can provide a trader or investor the greatest probability of success and it becomes one of the best ways to generate a steady stream of income. And it's all based on the math of probabilities. So in this example, you'll see this bell curve at the top. You've got a price. This is Google, $500. So your pricing of an option always starts at the money. Now, it starts there because that's where all the supply demand is, and then once that option price is done, then the market makers will set the other prices going out on the other strikes, going out and going down, and this is called your skew. Now, the main things you need is to know, okay, where it is trading at the money, that's implied volatility or its implied move, in this example, plus or minus 4%, and days to expiration. So you put those into your model, and then it spits out these prices. So to the downside, you've got 480, 4% down. To the upside, you've got 520. And it's this point between these, from 480 to 520, this is your one standard deviation theoretical move, which is 68.2% probability that this price on Google, in this example, will close somewhere between 480 and 520 by expiration in 10 days. Now, by knowing these numbers, then you can kind of set targets. You know, hey, 520 is probably the high side of it, 480 the downside. Now, if I start buying options way up here above 520, then my probability of success is starting to really go down. You can see the tail here, you know, it goes down lower and lower as far as your probability of success or being in the money. So, you know, trading probabilities, and as you know, trading is a business of probabilities, and to be successful, you need to focus on controlling your risk, and one important step is to know the winning probabilities of any trade that you take. And a really simple and free tool that you can use to measure probabilities is the option delta, which is one of the option Greeks. Now, the option delta is a great tool because not only will tell you what the value of an option will be based on the underlying move, but it also can help you to measure the probability of a price move on the underlying itself. Now, here's an example. So if you have an option delta of 68 on your plan, this equates to the strike as having a 68 or 70% probability of it being in the money at expiration. So that's another quick and dirty way you can look at option delta. And this would also be a 68-70% probability then as a one standard deviation move. So an option delta, if you look down here, of about 16 plus or minus 16 is then equivalent to that outside one standard deviation point. So if you look down here, you can kind of see that right here, this 480, that's that outside point. That's a 15.9% probability of getting there, and then anything beyond that goes down from that 15.9, and then up here the 520 is the other point. So these are very helpful as far as trying to determine probabilities of price. Now here's another way for you to really see how this option delta really can be used for these standard deviation moves. So this is an option platform on Thinkorswim, and you'll see that the option price here on Google is 582.45. Now I go over here, and you can see here 22 days to expiration, and then I look over here, so it's trading at 582. Now if you look down here at the price slices, this is how you can determine standard deviations on an option platform. So you just set it to a +1 standard deviation or -1, or you can do 2. And so when I set this here, it pulled up this number, 622.28 to the upside and 542 to the downside. So here's your one standard deviation, 622 to 542. Now, if you come over here to strikes right here and you go down to that 620-ish level right here, go across over here to delta right there, that shows you an 18 delta. So it's very, very close. So it's a really quick and dirty way to look at probabilities. So going to 620 is basically saying you only got about an 18% probability that that price will be there in by expiration. And it's using this probability analysis that provides the trader a really great tool for determining price targets to trade against, and it's going to be free to you on most platforms. So based on the math of probability, you can see that approximately 68.2% of options bought will expire worthless, and it's based on this. It's a really good idea for all traders or investors to also consider the sell side of things just as much as you do the buy side. So it's going to be this added option strategy that can really make a dramatic and positive difference in your trading performance when you use it correctly. So then step 5 is, well, selecting the right income strategy. Now the goal of every trader, again, should be really to select trades based on what provides you the most consistent positive returns and not always that greatest return. And one way to do this is by knowing what income option strategies are available and then selecting one that best matches your trading style or your kind of lifestyle or your trading plan. Now the income strategies that are out there, the main ones are going to be the covered call, calendar spreads, diagonal spreads, long iron condors, and credit spreads. Those are the main kind of income strategies. And they're all good ones, but sometimes they're better in certain situations than others. But my favorite option strategy is basically the credit spread, and it's for 3 good reasons. Number 1 is that they can work regardless of market direction. They can almost always work even if you're wrong, which they have a lot of flexibility to them. And the probability is over 68% even without adding technical analysis, which then would just increase that probability even more. So they give you a lot of cushion. You can not be exactly right on price and not be exactly right on timing, and you still make money by using the credit spreads. Now there are 3 basic types. You've got the bear call credit spread, you've got the bull put credit spread, and then you've got a long iron condor. Now the bear call credit spread is best if you think that the market's going to go down, and this is a bearish strategy. So all you're really doing is selling one call with a lower strike while simultaneously buying a call with a higher, so you're hedged. Now here's an example of that. So here's a bear call credit spread example, and here was the SPX trading at around 1988 right here. Now you can see up here that red line, that's your short call, the green is your long call, so you're hedged. So you're short the 2045 call there and long above the 2050. So you can see there's a lot of cushion up here, so you don't have to be exactly right on price, you don't have to be exactly right on time, and if it expires below that line, in this particular situation you would have received $100 credit. Max at risk if you did nothing at all was $400, so that's a 25% return on your margin, which is what you put up. That's all that's put up. Now this is without doing any type of defensive action. So that's what a bear call credit spread looks like. Now then you've got 2 is the bull put credit spread, and it's used when you think the market's going to go up, and it's a bullish strategy. So basically you're going to sell one put while simultaneously buying another put with a lower strike. And here's an example of that. Now in this example, this is showing when, and it's trading down here at $207. And in this situation, you could have bought the calls or options or stock itself thinking it's going to go up, or you could have done this bull put credit spread way down here by selling that 187 put short, buying the 182 below it as your insurance. In this example, you collect $130. The difference in the spread is less the credits, $370. So as long as win can close above this short strike, you will make $130, which is a 35% return on the capital at risk, which is at $370. That's all you'd have to put up is your margin of $370. So that's what that looks like, and it's a hedge strategy, so you know what you're doing when you're going in. Third strategy is the long iron condor, and it's known for being a non-directional type of low risk strategy, and it's basically just combining the bull put credit spread with the bear call credit spread. Now here's an example of that, and this is, you're basically selling those 2 spreads at the same time, or you can leg. Now here's Amazon, it's just trading sideways here at about 331. So here we're selling that bear call credit spread, strike short there, long right there, selling the put spread down here, and buying the protection below it. So you're short the 345 call, long the 350 on that credit spread, short the 320, long the 315 on that put spread, collected a total of $150. So it's a $5 wide spread less the $150 you collected. Maximum that you could lose if you did nothing at all is $350. Now if Amazon closes between these 2 short strikes, that's a 43% return on your capital. So these are really nice, decent returns to look at. Now here's something very interesting we'll go through, is comparing the risk to reward on two different buying strategies. One is the traditional, just let's go long calls, we think the market's going to go up. And two is let's sell out of the money bull put credit spreads to kind of maybe reduce our risk. Let's see what these look like. So strategy one is to buy the at the money June 207 calls this is on WIN at 11.40. So it's going for $11.40. So that's, you know, 1,140 for an option contract. You've got infinite upside. You've defined your risk to 1,140, but you know that's still kind of expensive. Now strategy two is still a bullish strategy for the market to go up, but in this one you're selling the 187 put, buying the 182 bull put credit spread. You were able to sell this below where WIN was trading, and also lower than its prior low of 189, and 9.5% below the current at the money price of 207. So this is what it looks like. Now WIN, you know, had a nice pop here. Here it was at 207, so you bought that at the money call. It had a nice pop up, but then it collapsed. And you look down here on the 8th, it's now trading at 196. You look over your P&L, and now you're down $583. That's smarts. So the next thing you look at is, well, okay, what happens next? So on the 21st of May, it finally comes back up, and it's trading right here at about $205. So it's $2 below where you initially put it on, but you're still down $518. Still smarts. Now if you've done the bull put credit spread, here's what it looks like as far as your risk. Now here you sold way down here, right, that credit spread. Now when, you know, drops down here to you know, down here to let me go to the next slide. So when drops, you know, down to that 196 price right there, and you're still above your credit spread where you're short, you look over at your P&L here and you're down $38.50 per contract. But the other strategy, you're down $583, so huge difference there. Now on the 21st, you can see here that WIN had moved back up to 205, and right now on that bull put credit spread, now you're at 78.50, so you're back into the green. But the long call is still, you know, under the water at 518. So you can really see from this example the difference between those two bullish strategies. Now another really great strategy I love using credit spreads is what I call the in-the-money vertical credit spread positive risk ratio. So you were seeing in those other out-of-the-money type sell credit spreads, those were negative risks where you were getting $130 on that WIN trade, but you could potentially lose 370, so that's a negative risk ratio. Now, when you go into the money on these credit spreads, you can turn that into a positive risk ratio. Here's an example of that on Baidu. Now, this is also target, I call it target price trading using these because you have to have a good directional target. Now, in this example, Baidu was breaking out to the upside, so you could have gone just long Baidu, you could have gone long calls, so you can see a nice breakout. Or you could have done it in the money, deep in the money, bull put credit spread, and this is what that looked like. So on this particular trade, Baidu was trading at 219.50. Now these were short-term option trades. This was on the 2nd of September and out the 5th, so it was a really quick in and out. So it was trading at 219. So in this one, based on targets, sold the 222.5 strike short, and it was trading at 219, so that was $3 in the money. Now, by doing that, you were able to collect a really big credit of $181 per contract. Now, this was a $2.5 wide spread, so you were able to collect 181 less the spread of 250, so that gives you the max at risk is the difference of $69. That's the maximum you can lose on this type of deep in the money credit spread. And that's the maximum capital that's at risk and put up on margin. So you can see this, if you were to make that 181, keep that full credit, your capital of 69, that's a 262% return, or a 2.62 to 1 positive risk ratio. So here it was 181, max at risk. So that's the kind of setup that you can achieve when you go deep in the money. And here it was when it did close, you know, it closed above, it closed at above your short strike of 222.5, So this was able to keep that full credit of 180, and that was the max profit. So it's a big return, and in a very short period of time, and on a very little amount of capital. Now, here's another one that was just actually today. This was a setup for today, and this was on Chipotle Mexican Grill. And this was Chipotle looked like it was going to break down hard to the downside. So you could have, sold the stock short. You could have bought puts, a couple of different things here. But this is a setup by selling. This is not a bull put credit spread. This should be a bear call credit spread. So that's wrong. I'll have to change that. But so this is a bear call credit spread, and I'll show you how this looked and how this turned out. Now here's Chipotle. This was a shot of it currently right about an hour ago, and you can see this is what we call a volatility squeeze. So this morning it looked like it was going to trigger lower, so I wanted to get short. So one way to do this was by selling that bear call credit spread, and this was setting that up for an in the money setup. So here's what that looked like, and now this was selling the options that expire next week. So this was the June 1 option series right here. So that was not this Friday, but next Friday. So this was selling the 620 strike on the call, buying the 622.5 above it. So that's a $2.50 wide spread. Credit received $165. So the maximum potential difference would be the difference in the $250 wide spread minus the credit you received. So the maximum at risk on this trade setup was $85. So just the difference between that credit received 165 and the spread width, which was 250. So maximum at risk 85 to make 165. So you can put up very little capital, and that's a good way to turn a small account into a bigger account. Now here's what it looked like about an hour ago. It dropped down to below 614. At that time, it was time to exit. So here it was at 614, dropping down here, and here's the credit spread put on at 165. Now, when that dropped down there, the this credit, which started the day at about almost $2. This credit then dropped to 80 cents. When it was trading at 614 right there, that credit was at 80 cents. So you could buy that back, and the difference was your profit of $85 per contract. So that actually turned out as a day trade. 2 contracts is about $171 profit for a trade that was put on, set up in the morning and taken off, in the afternoon. So a lot of different ways you can use these things. They can be, longer term. They can be very short term, as you can see there. So it's a very great strategy to add to your, currently what you're doing if you're not using this type of these type of setups. So what I'd like to talk to you now, got some questions here, can go through, should have some time for questions, and I'd also like to tell you about a really great opportunity here if you want to learn more about this type of trading. But first, everybody here, I'm sure you don't know me at all, so if you don't, just take a few minutes here and read these little credits here, and hopefully it'll be worth your time there to do that, and then I'll get into your credits and tell you a little bit more about a course offer that I'm going to make to you. Okay, well, so I wanted to share that with you. Now, let's talk some simple steps you can do right now to generate a more, steady stream of income, or help you to generate a more steady stream of income. And this is a course that I put together that's 100% on these credit spreads. It's kind of hard to go through 45 minutes and tell you all the ins and outs about how to use them, but here's a really great course that I put together. It turned out to be a 5-hour course, and here's the link that you can use right there. So use powercycletrading.com /PICK. Just put that, copy and paste that into your browser. And what I'm doing here today is for the first 30 that sign up, Now you're going to get this course at just $97, but you're also going to get some additional bonuses. And what you're going to get is a follow-up live accountability and support Q&A, which will be, we'll do it in about 2 weeks, so you'll have time to go through the course. And then we'll have a live Q&A where you can come in, we'll show examples, you can ask questions, and have a lot of good follow-up to the course. Now this course was done, it turned out to be 5 hours, and it's recorded in 30-minute modules, so it's easy for you to go back through, the course, the various modules, and it's yours as soon as you buy it. It's also going to come with the training manual, which is the PowerPoint. My courses are very, very detailed as far as the PowerPoint, so you get all that, and you can write on that, take notes. And then I'm also giving you a 13 option strategy diagram with some really great option strategies that you can use. So all of this, and then the first 30, I want to keep the group small. Now, it's a win-win situation, because if it's something that doesn't work for you, you just send us an email, and we'll refund that $97. So if you want to get started on looking at a different way to trade, and also to help you with your current trading, to learn a little bit more about selling premium, here's a great way for you to get started. And here's the link again for you to make it easy for you. Just copy that and then paste it into whatever browser you're using, and it'll pull up just an order form. Now, in this course, the course I'll take you through this course, it's going to be on how to use its 100% credit spreads to create kind of a low risk, high probability trade setups, like a couple of examples I showed you, and then how to use credit spreads for stocks, index options such as SPX and NDX, and also the ETFs. And then how to use non-directional credit spreads and when should you use those certain situations, and how to use those deep in the money, when should you be using those, and how do you set those up. And then it's great for looking at taking a small account and turn it into a bigger account on very small amounts of capital at risk. So you can see that you can do these credit spreads for $60, $70 at risk and make 2 times that. And then in those particular examples, I show you what you could risk and have at risk, but I didn't show you any of the defensive strategies. And so in the course, we spent a good chunk of the time teaching you 6 defensive strategies for defending those particular trades if they do go against you. And then also how to use that iron condor and when to use it and when not to use it. Now, another great thing about credit spreads that I like to use them is to use it to also diversify my risk on trades. So I'll use it for position sizing. So, let's say you have $2,000 that you might want to spend on one type of trade setup. Say you're long, say you're bullish on Apple. So you could just buy Apple stock. You could buy calls. Well, you could do a combination and just diversify the risk by also adding some credit spreads into it. So I go through and show you how to do that. And the really cool thing too is then how do you take a 70% probability of winning and turn it into 90% probability. So that's shown in the course as well. And then a step-by-step guide for your execution. Fibonacci analysis, I use a lot of Fibonacci, so we spend some time on that using Fibonacci analysis for your price targets. And then time frames, when should you be using those spreads, and when you can put them on at the end of the day so you don't have to stare at your screen all day bug-eyed. So there's a lot to this course. And also the great thing today is also for the first 30 that sign up, you'll also get that bonus Q&A follow-up in about 2 weeks, plus that 13 diagram, and a money-back guarantee if it doesn't work out and you need your money back. You just send an email. So it's a win-win situation, and hopefully you'll get a lot out of it. My clients and members have just loved this course and get so much out of it. So. That's what I wanted to show you here today. And questions, I've got a couple here. How accurate is the option delta? Well, the option delta is what I use for kind of a quick look at the market. Now, as you could see from the platform, that one example I gave you showing you what the exact 1 standard deviation move, you can see that it's very, very close. So it's it's not 100%, but it's close enough for the kind of trading that most of us are looking to do. So when I'm looking to looking for something that's, say, a 1 standard deviation out of the money, I rarely will go to the platform and go through all the analytics. I'll just usually look at that option delta, and I'll look at something that's about a, maybe a 20 delta or 17, 18 delta, and that to me is saying that that's about a 1 standard deviation price point, up or down, depending on what I'm looking at. For weekly options, do you enter on Thursday? Yeah, sometimes I'll enter on Thursday. I rarely do enter on Friday, but I'll enter on Thursday, or I really like Tuesdays. Tuesdays are great because then you really get that accelerated option theta decay. And here's that link again. A couple of you have been wanting that link. There it is again.